Definitely.
Good morning. Thank you all for coming and for watching online. I'm David Wessel. I'm director of the Hutchins Center on Fiscal and Monetary Policy here at Brookings. Our mission is simple: to improve the quality of fiscal and monetary policy and public understanding of it. I'm not sure which of those is harder. We're meeting today. We convene this because we're at a really interesting and indeed a pivotal moment in Federal Reserve policy. Because of the Great Recession and the financial crisis, as bad as most of us have seen in our lifetimes, something that rivaled the one that led to the Great Depression, the Federal Reserve did extraordinary things. It cut interest rates to zero at the end of 2008. And I doubt that anybody thought at the end of 2008 that we'd be sitting here in 2015 trying to decide, so is it time to raise them or not? The Fed engaged in what's called quantitative easing, bought trillions of dollars of bonds and mortgage-backed securities in an experiment in monetary policy that people will be studying and writing about for a generation to come. And these techniques have been matched and amplified and amended by central banks in the UK, in Europe, in Japan, and they represent a lesson in economic history that we will be learning from for a long time. But the policymakers at the Federal Reserve don't have the luxury of waiting for the next Milton Friedman or Ben Bernanke to write about the history of the 21st century. They have to make decisions now. And fortunately, the U.S. economy has strengthened. Unemployment has fallen 5.3%. We're creating more than 200,000 jobs. And so there has been a sense among some people that, okay, it's time for the Fed to begin to ever so slightly tighten the spigot and raise interest rates. And I think that safe to say a couple of months ago or maybe a month ago, there was a kind of consensus that the time had come. And then somehow the world blew up. The stock market gyrated. The Chinese devalued the currency. Their stock market crashed. Mario Draghi said this morning at a press conference at the ECB that the rest of the world looks worse than he expected, and financial conditions have tightened. So that is something the Fed has to take into account. So today we're going to discuss what should the Fed do, what will the Fed do, not only next week, but in the months and years to come, given that they're in uncharted waters. And I have a very distinguished panel of experts here. And I want to make clear, this is not a cross-section of America, nor is it meant to be. These are four economists, all of whom have worked at the Federal Reserve at one point in their career, all of whom believe that we should have a Federal Reserve. This is not the end the Fed crowd, or nobody here wants to go to the gold standard. I suspect, although I may be surprised, that nobody here thinks the Fed should forever abandon its interest in controlling inflation, even though inflation is very low right now, far from their target. So these are people who have a sense of how the Fed works, but are outside the Fed and can think about how the Fed might do things to have a greater chance of achieving the goals that were set by Congress: stable prices and maximum sustainable employment, with an implicit now mandate of, oh, and by the way, we'd like to not have another financial crisis. Julia Coronado is at Graham Capital. Joe Gagnon is across the street at the Peterson Institute for International Economics. John Faust, who had worked closely with Janet Yellen, is now back at Johns Hopkins and can tell us what he really thinks. And my Brookings colleague, Don Kohn, who, among his many accomplishments, was vice chairman of the Federal Reserve Board during some of the worst of the crisis, and in addition to being at Brookings, is a member of the Bank of England's Financial Policy Committee, which has to weigh the financial stability issues that confront us today. We're not going to have any opening statements. We're going to have a conversation, and we'll invite you to join it sometime later in the hour. So I thought it would be useful if we just started by, if I asked each of you to put yourself in the position of the Federal Open Market Committee, and what are the things that you have to look at as you decide, so is September the time to raise rates? Should we wait till December or maybe even later? What are the cross currents that you think are being weighed, and then we'll get to how you'd weigh them. Don, do you want to take a start?
Sure. So if I were, if
I had to vote in a couple weeks, I think I would start by thinking about my outlook for the economy in 1 to 3 years. So monetary policy works with a lag. Whatever I decide now has no effect on August's employment numbers that we'll be getting. That's in the past. And it will have very little effect on employment or inflation over the next 3, 6, 9 months. So I have to think about where we're going to be in 1 to 3 years. I think in that regard, so I like to think of the Fed's decisions as being outlook dependent. The Fed talks about data dependency, and data are important, but you have to be careful not to overreact to individual pieces of data, and by sort of processing the data through an outlook, a forecast, I think that's one way of trying to extract the signal from the noise of the data and not overreacting and think about how it affects where things will be 1 to 3 years from now. When I think about where we've been over the last couple years, I see very steady progress in the labor market. So particularly the last 2 years, we've been creating jobs at more than 200,000 a month on the establishment survey. That's more than twice as much, about twice, maybe a little more than twice as much as we need to tighten the labor market. So from a labor market perspective, the U.S. economy's been doing pretty darn good. Now that hasn't been associated with very good growth, 2.25% growth, but that's because potential growth has been so weak, with productivity around 0.5% over the last few years. So I think focusing too much on growth can lead you astray. You got to think about the labor. The two objectives that David pointed to were the labor market and inflation. And the labor market has been tightening, and there's probably some slack left in it, but we're using that up pretty quickly. So I start from the perspective that, and as that is used up, and if we overshoot the maximum sustainable employment, which I think we probably will by at least a little, that'll push inflation back to the 2% target. So I start from the premise that interest rates are going to have to rise at some point, and in my mind, before too long. Now, exactly when they increase isn't all that important. If September, December, that's not very important. What's important is they have to start rising, and what's important is the track for interest rates, the total path of interest rates once they start to increase. Now, one thing that might make me hesitate, even though I think interest rates need to rise, one thing that might make me hesitate to do it in September is, a couple things. One is inflation has been very low and hasn't shown any sign of increasing. I don't need to see that rise in inflation. I think labor market's tighten enough, inflation will come back and we'll get up to the 2% level, but it would be a little reassuring if you saw a little more there. So the fact that inflation hasn't risen, wage gains haven't picked up, wouldn't hold me back entirely, but they do make me hesitate a little about moving sooner rather than later. And the other issue is the turbulence and volatility in financial markets, and the fact that expectations of a Fed increase in September are still pretty low. So I think I'd hesitate to raise in September because of these market situations. Don't know what the emerging market outcome and the Chinese outcome is going to be. But I would if I didn't raise, I would put very strongly on the table an expectation that rates would go up. I would retain the wording about later this year and make that the default proposition. And I think that would help to build in the expectation of higher rates later this year and put that in the market. So when I finally did move, it wouldn't be such a surprise.
So, John, do you disagree with any of that?
So I very much agree with that position that Don just gave. I'd like to add a little color, I guess, of my own, or some details that fill it out a bit. When you think about that outlook over 1 to 3 years from now, one of the things that's important to realize is that in any given announcement, like Friday's employment report or any other data announcement, we learn very little about where the world will be 1 to 3 years from now. That evidence accumulates very slowly. So Friday's employment report won't change that outlook much, and thereby won't change the decision much. If that number comes in at 100,000, which is lower than the above 200 we've been seeing, well, there's revisions. That's 1 month. There's a long history now of pretty steady job growth. So that evidence accumulates both on the real side about how fast the labor market is healing, and on the inflation side, that evidence accumulates slowly. The FOMC now reports that it's expecting it to take a few years for inflation to get back to 2. So it's going to move slowly there, and the FOMC has said that they want to have reasonable confidence that it will move back toward 2. And you might ask yourself, if they decide to delay in order to gain more confidence on that point, where could that confidence come from? Well, as it turns out, and as Vice Chair Fisher said last week at Jackson Hole, because of energy prices falling, we're expecting inflation to go down for a while for purely transitory reasons. That's nearly baked in the cake. Now, that shouldn't affect your confidence about what happens 1 to 3 years from now at all. Oil prices go up, they go down, it affects inflation. So that doesn't affect your confidence at all. It may make, if you wait, it may make the optics a little more peculiar that inflation's even lower and you moved later. But it shouldn't affect your confidence about where inflation will be 1 to 3 years from now. So what should? Well, I think we're back to what Don referred to, which is the real side of the economy. That is the labor market continuing to tighten? Are you confident that it will continue to tighten? And I actually gave a paper at this Jackson Hole symposium saying that relationship between labor market tightness and inflation isn't very well understood, especially at the current moment. But everybody, I think, believes that at some point, as the labor market tightens, it will provide upward pressure on inflation, and we'll see inflation emerge. And almost everybody believes we're getting near that point. And so that's where the debate is. How close are we to that point? Are we close enough to that point to gradually begin going from an extremely accommodative position to just one that's extraordinarily accommodative? And that, I think, is what the debate's about. And finally, I'd emphasize that the particular timing of the first liftoff, which everyone, Don said, all the FOMC has said, doesn't matter so much. It's the path over time. And they've laid a lot of groundwork that's very likely to be slow unless the economy booms or wondrous things break out everywhere. So that's the framework, and I think what they'll be debating in September is whether they still have that confidence that the labor market will continue to heal, because that's where the confidence about inflation returning comes from. And can I say just one other thing? Sure. David said the world blew up, and it's important for us to, in the last few weeks, it's important to realize that the real side didn't. You can go ask people, did they fire a bunch of people? Are they still producing automobiles? Well, I think so.
United States.
So in the United States, it didn't blow up in China. The markets acknowledged.
No, it did in Tianjin.
Well, that's true. The markets acknowledged some accumulating evidence on the real side in China. So I think first and foremost, you try to look through pure financial market volatility, and the question you ask is this volatility telling us something, that the economy is fundamentally weaker, so that I can't have confidence that inflation is going to return to target? That's really the question. And that relationship we don't understand really well, but there will be a intense discussion about that. Does the volatility signal something about the underlying economy, or is it like a lot of volatility in financial markets, the kind that will ultimately leave no trace in the data?
Okay, but Joe, let me turn to you. So I get that it's very comforting to know that the Fed doesn't understand the relationship between inflation and employment and the relationship between financial conditions and inflation. But as we said, and as I know you have to make decisions based on what you know and on your best understanding. So, Joe, let me play the devil's advocate here for a minute. The only reason to tighten is the unemployment rate is down. We still think, some people think there's still slack in the labor market, people who've dropped out who might come back, a lot of people working part-time who'd rather have full-time work. We clearly don't have an inflation problem here anywhere in the world. Compared to a month ago, there's got to be some wealth effect, and it's got to be somewhat less concern that we have a bubble in the stock market. And I don't know how much worse emerging markets are, but I know the direction, that China, Brazil, nothing good there. And commodity prices are falling, so it's not just that the Chinese are making up the numbers. I mean, copper and oil are lower. So other than the Fed saying we want to raise rates in 2015, why is it even on the table now, Joe?
Well, I think it's what Don started with and John continued with. I think it's important that you have to look ahead 2 years. That's the horizon over which policy takes effect. And up until a month or two ago, I was very much sort of thinking, well, if they raise rates in September, that makes some sense. Looking out as with the steady employment gains, in 2 years ahead, we'll probably be even slightly overshoot full employment if this continues, and so you'd want to start the policy normalization process now. This is small and gradual, and they'd have plenty of time to reverse course or stop if things develop badly. I think now I am moving away from that, and for the reasons you said. I would say it's not so much volatility in financial markets as the level. I just look, the stock markets around the world, including the U.S., are down 5 to 10% of where they were when they last met, when the FOMC last met. That's notable. And then that has effects on spending and wealth around the world. There's also, the dollar is up about 2% on a broad trade-weighted basis since the last meeting. That's not trivial.
Because it acts as a kind of brake on exports.
It's a brake on exports, which has been the biggest thing slowing us down this year.
And a depressant on inflation.
And it reduces inflation. So for all these reasons, it seems to me probably it would be better to wait. And in particular, just one final point. Given how the succession of over-predictions of growth that the FOMC has made and been disappointed for so long now. 1 or 2 years, fine, whatever, there's noise. But there's been so many years now. And undershooting inflation target for so many years now.
But they've underpredicted the labor market growth. So there's this productivity puzzle. So
there is a productivity puzzle.
So they've been pessimistic about unemployment.
But we've been below the inflation target for so many years now if you made a mistake and inflation went up to 3% for a year or two and then you had to tighten to bring it back, that strikes me as nothing to worry about.
So in other words, is this what you think they're thinking, or this is what Joe Gagnon
this is what I'm thinking.
And do you think that they'll look at the world the way you just described it, or where do you think you diverge from
They
them?
do look at the world a lot, but my gut feeling is they probably have weighted the rest of the world and the dollar a little bit compared to what I would do, but not by a lot. Not that they ignore it.
So, Julia, what do you think, and where do you perceive that the markets are looking at, either like the Fed or different than the Fed?
That's a very important point. So a couple of things there. So the market right now, there is a message from the Fed right now that the timing doesn't matter, it's about the path. That's not entirely true for the markets that translate Fed policy. The timing does tell us something about the Fed's reaction function, how they're weighting these different developments relative to our view of the world. And it's not just that it's September or December with a known path. We're learning information about how the Fed is weighting these different developments. So the timing actually does matter very much.
You mean because if they move
message.
sooner, it suggests they have more confidence in the economy?
Exactly. So if they move in September, it would tell us that they are not weighting the global developments very strongly. They are not weighting the inflation disappointments very strongly. They're weighting the labor market much more strongly. The markets are already signaling, the markets today, I checked right before we came, are about 20 to 25% priced for September. So it would be a very big surprise for the markets if they actually raised rates.
And we wouldn't want to surprise the markets.
And the Fed would not want to surprise markets. I think there's an important element of Fed policy that's always been there that we aren't talking about in our 1 to 3 year, and that is risk management. The Fed has cultivated this recovery so carefully with such enormous effort for the last 7 years. Are you really going to take the risk in this environment with global, unstable global financial markets, with real macroeconomic questions about the global outlook that are not just about volatility, but the volatility came from significant data disappointments around the world. We've got the BRICS, the wonderful BRICS, Brazil, Russia, India, China. 3 of the 4 are arguably in a recession. 2 demonstrably, 1 we don't know the data very well, and India is sort of the only okay one. That's important. That was a macroeconomic catalyst to the volatility that then has rippled back onto our shores. Are we going to be resilient to that? We have a good shot at it, for sure. There's a lot of domestic strength, but at this moment, I think when the Fed decides that now is the time to begin that process, the message and the moment matter very much to whether the markets say, yes, this is the right and good policy, or this is a policy mistake. And when I did a survey of our portfolio managers, their median expectation was about 20% that the Fed would raise rates, so in line with broader market pricing. And then I asked them, how would markets react if they did? And the universal answer was, to some greater or lesser degree, it would be a policy mistake.
Okay, so are you what odds do you put on September?
So I would put even lower than 20%, maybe 10 or 15, because I don't think the Fed would go.
What, Joe, do you want to put odds?
30%, 40%.
John, you can say no.
I'm considerable higher than 20%, but I don't have a particular number in mind.
John?
I'm with John and Joe. So I think it's probably less than 50-50, given all the developments Julia talked about, but higher than 20.
And do you all agree that, based on what we know now, and the world will change, that before the end of the year still remains a greater than 50% chance?
I do, yes.
I think it's about 50-50 that we'll be able to go.
Joe, you look a little doubtful.
I think it's slightly more than 50% on the assumption that there's some recovery in markets.
Right.
And
John?
Yeah, so long as things stabilize. What I think that we've all agreed with is that the important thing about this volatility would be the macro signal that's behind it.
Right.
And that's what they're going to be looking at. Well, we'll learn about whether that turmoil in China or...
We'll learn a lot more before year end.
And if it proves that it's either impacting the globe less than we thought or not transferring here, then yes, they go. And to the greater extent it's slowing us, then the lower the probability.
Okay, so when I came to Washington and started covering the Fed in 1987, the Fed basically said nothing when they raised rates. I mean, that was the good thing about being at the Wall Street Journal. You could suss out whether they'd actually made a policy change. And we've gone a long way, and as a former reporter, I'm in favor of transparency. But as I look at Fed communications today, I sometimes get a little bit of a headache. We're data dependent, but we're going to raise rates in 2015. We don't want to be predictable, but it will be gradual. So is this...
I'm not sure they said that one. They'd be happy to be predictable, but predictions aren't deterministic, mechanical.
Yeah, right, like I said. But it goes to my point. So is this just the world in which we live, that it's very hard for the Federal Reserve to make conditional statements, which basically amount to, if the world unfolds the way we do, this is our plan, but don't hold it to us. Don't hold us to it if the world changes. Or could they have done a better job of framing the conversation? And particularly, have all the conversations from all the members of the FOMC who are mailing in their votes via press conference or press release or interview, is that making things better because we see the debate, or making things worse because it suggests that the meeting is just a pro forma thing? Anybody?
So let me pick up your last point. I do worry about this. The members of the committee seem to have made up their minds before they come to the meeting. I haven't heard any of these people say, boy, this is a tough call. I'm kind of leaning this way because here's how I'm reading the economy and inflation outlook and where we'll be relative to the Fed's dual mandate. But I'd really be interested in listening to what my colleagues on the committee say. I've never heard that phrase.
That's transparency. They're telling you the truth.
Bothers me as someone who was the secretary of that committee for 15 plus years and sat on it for another 8. I think the discussion around the table isn't always informative, but it can be, but you have to listen to each other. So I think that's this pre-commitment, and then changing your mind every month or two when a new piece of data come out. So yeah, it's going to be September. Well, I'm not so sure now. Well, maybe. I don't think that's helpful. I don't think it's framing the economic conditionality behind the decision as well as it should. It just focuses on, in essentially the left side of the reaction function, what you're going to do with interest rates, rather than the right side, what are the economic conditions that will frame that.
But Julie, do you think their communication has been as good as possible in the circumstances or not?
I think there's room for improvement. I think I agree with the point that the data dependency has, look, there was a lot of concern, I think, or a general conclusion by the committee that giving too deterministic a path for rates, the measured pace, sort of engendered market complacency, and they don't want to repeat that mistake. And I completely understand and agree with that proposition. I think the pendulum has swung too far to the other side, where they're inadvertently stoking market volatility on high-frequency data releases. And I don't think that really represents how they're making decisions, but it's a combination of the way they're describing data dependency publicly and reacting to different data, going on CNBC after the employment report and saying, well, that's a pretty good number, that's not helpful. And like the every meeting live, we could go at any time, it's very data dependent, again, tends to focus markets on, well, if the payroll number is good tomorrow, we could go. I don't think that's going to be the nature of the deliberation. The deliberation at the table will be looking at the fullness of the accumulated progress, the outlook, the risks to the outlook. So I think the tone of the framing of the reaction function hasn't been optimal and has perhaps inadvertently led to a situation where the Fed is causing market volatility, the very market volatility that might then make it difficult for them to announce a decision. Somewhere in between, there's a medium where you can provide some guidance. This is how we're thinking. Give us a little runway to anticipate that, and perhaps not, so that the dollar's not spiking ahead of every Fed meeting. And
John, so I think there's some people I've heard who say, look, as you did, we're nearer to the point where having zero interest rates doesn't make sense. This anticipation of the Fed is worse than the reality. We know that everybody's nervous about what's going to what markets are going to do when the Fed finally pushes the button. People who lived through 1994 when the Fed raised rates and thought they had telegraphed it and surprised markets, and we end up with financial crisis in Mexico and the bankruptcy of Orange County and all that. I understand why they want to be cautious. And other people who look at history and don't want to go down as the Federal Reserve who repeated the mistakes of 1937 and just at the wrong moment tightened. But that said, is there a case that, okay, at 5.3% unemployment, 0% interest rates are too low, the markets have been frothing at the mouth about the Fed's going to do this. Would it be better if the Fed just got on with it so that people could get used to the idea that zero interest rates are not a permanent condition?
Well, I think there might be something little to that. I suspect that the FOMC won't move just to move. That's not generally the way they work. But another way of thinking about it is that the initial move, the precise timing of the initial move, is of not of great import to the real side of the economy. It is to some folks who deal at that end, very short-term financial markets. And so the particulars, doing it now as opposed to a month from now or 2 months from now, might make sense. But I don't think that whole argument will be that's a footnote, I believe. What it's the discussion of where the economy is going to be in
Right,
in
okay.
1 to 3 years, and that will turn on.
Why then so much emphasis on gradual? You've all said that that's important, that they say it's going to be a gradual. Why is that? What's the reason for that? Why
That's
should we
the
be
statement about how they believe the economy is functioning.
not well, in other words?
Chair Yellen at the San Francisco Fed earlier this year gave a nice description of this, that the economy, the interest rates or financial conditions consistent with some continued progress in the labor market and with inflation getting back to target, that's likely to be a gradual path. And if you say data dependent about that, it would be, we'd all love it if the economy boomed, and then obviously we'll tighten faster, but we haven't seen that happen over
And
the
we
past
don't
6
want
years.
people to think that we're going to get interest rates back to normal, whatever, 3.5% over the next 12 months, because then they would behave accordingly, and that would have bad effects.
Yes, exactly. Thank you.
Joe, please.
Can I just add a point? You talk about zero and, this extremely accommodative. I don't think we know, certainly with the labor market, it appears to be accommodative. Yeah. It's not accommodative when we look at inflation. If we look around the world, we used to think. Okay, so it's a lagging indicator, but let me just.
Okay.
We look around the world, and now we know that zero isn't the lower bound. We have a number of central banks at negative rates. We have a situation where there is an exchange rate mechanism that is unusual because of the divergence in the economy. So every time the Fed raises rates, you do have, or even steps towards raising rates, you have this reaction in exchange rates, which do feed back into the economy on export growth, on inflation, and through a number of channels. So it's a very difficult time to calibrate, and this sort of presumption that zero is just this crazy accommodative rate. That's an assumption based on past history, which may or may not be applicable. I think in Chair Yellen's speech that you just referenced, she framed it as, what is the true equilibrium funds rate right now? We don't really know. We know it's pretty low because at zero in the past, you would have had the housing market on fire. You would have had a lot of froth in the financial markets. It would have been a very different world at zero in the past. At zero, we're kind of muddling along at 2% growth. Labor market, thumbs up for sure, but no wage growth yet. So the Phillips curve isn't quite operational yet. We hope we're getting close. We think we're getting close. So zero may not be the zero of yesteryear, and that's something the Fed has to grapple with right now, too.
Joe, let's talk a little bit about the rest of the world. Don and I were in China last week, and it's kind of amusing to hear some of the Chinese hadn't updated their talking points, so they're complaining about spillover from the U.S. to China. It seems like they learned that spillover is a two-way street, if you don't mind the mixed metaphor. To what extent should the Fed be thinking about the rest of the world? I mean, does it really affect unemployment and inflation in the United States a lot if China slows a little bit? Or is it that it's not just China, it's China and Brazil and Russia? Or is it that they should worry because what they do is going to have ill effects on the corporate borrowers in Malaysia and Indonesia? What is the international dimension that you think they ought to be thinking hard about? All of the above is allowed, but
No, if I could just say one quick thing. In addition to what Julia just said about the near-term interest rate, an interesting point to note is that where the committee thinks they're heading after a few years in the Fed funds rate has gone down over time, and I think it may have a bit further to go. We've gone from about 4.25% to 3.5%, and that's the median of the forecast, and it might have something to go further. I think this sort of reflects a global move towards lower interest rates and slower growth, which I think is not going to turn around soon.
Right. But, subject of an October 30th discussion at the Hutchins Center. You're invited.
But no, I think the reason to worry about the rest of the world is not that the Federal Reserve is answerable to voters in Brazil or China, but that what happens in Brazil and China and elsewhere affects the U.S. economy, and we're an all interdependent world, and exports as a share of our GDP have grown over time compared to where they were 30 years ago. And so it matters a bit more. Not that we're still relatively close compared to many countries, but we're not isolated. So absolutely it matters. And I think these large declines in stock prices around the world are going to probably reduce investment and maybe consumption around the world, and that will hurt U.S. exporters. I mean, U.S. exports a lot of investment goods, so stock price declines could have effects that are measurable. And the dollar being stronger also is going to hurt our exporters. So, and that takes time to show up. So, you know, a good employment report for August tells you nothing about the 2% rise in the dollar in just the past 2 months, and the effect that will have going out a year or two.
I think that's an important point. That and the news we've learned about the economic strength in a number of these countries. When other countries slow, that feeds through to the U.S. economy over over quite a while. So we won't learn much about that next month either, or even the next month what the full import will be.
So is the point that so let's see, we're at the beginning of September now. If we go back to the beginning of July and we say, what have we learned since the beginning of July? Your point, if I get it right, Joe, is that whatever we thought about the rest of the world, it looks worse today than it did 2 months ago.
Worse and by a not trivial amount.
Right.
And I would also say it was always a risk. We always knew China was slowing to some greater or lesser degree. It's now very much in the data. You know, Brazil's second quarter of contraction was announced 2 weeks ago or a week ago.
Not to mention Canada.
Canada's in a recession. The Chinese composite PMI is at the lowest since 2009. These are hard data points that were where it was sort of a nebulous risk that we worried about. Now it's data that we can see.
John, I want to talk a minute about the Fed's balance sheet. So as I said at the beginning, when the Fed cut interest rates to zero, it decided that wasn't the most it could do, and it engaged in several rounds of buying lots and lots of bonds. And at the moment, they're holding that portfolio steady by reinvesting when a bond matures or someone pays off a mortgage. So, John, could you just explain for people what is the state of the Fed's current thinking, or what they've told us about what they're going to do with the portfolio? And then, Joe, I'll ask you about whether you think they ought to do something different.
Well, the Fed's announced some broad outlines or principles that they'll follow with the portfolio as things move forward, and I think the main thing that they would like to do is get back to interest rates being the main instrument of policy. So raising rates or lowering rates, that tells you what they're trying to do to financial conditions. And that they ultimately, obviously, would like to reduce the portfolio back to more normal sizes, and they'd like that to just be done in as smooth and with as limited a disruption as possible, so that isn't a signal about policy. That's more of a technical exercise, helping them get back to where they'd like to be. That's the broad.
And I think there are a lot of people, lay people, think that someday the Fed has to sell off all these bonds, and that if they bought bonds to lower my mortgage rate, then when they sell them, they're going to push my mortgage rates up. Don, what is that? That's not the way the Fed looks at it. What's wrong with that logic?
Well, I think there is something to that logic. The Fed's portfolio holdings have pushed down interest rates, partly just through a signaling of our intent, and that they can take care of with communication. But also just having the demand, taking those bonds, particularly long maturity bonds, off the market, have pushed down term premium. And I think as the Fed's portfolio declines, those term premiums should rise. Now, to what isn't a really clear thing, but I think the direction is pretty clear. If, as John says, it's just very gradual, it will hardly be noticeable, but it will be up. If they started to sell outright, and particularly if they sold in size outright, I think you'd have a very substantial effect on interest rates. And I would.
Consequently, you think that's unlikely.
That's exactly. So I was going to say, I don't think they'll even let the portfolio begin to run off until they get the federal funds up some, maybe towards 1%. Because what they're worried about, or what they should worry about, is we start raising rates and it turns out that things aren't as good as we thought, or there's a shock from outside the U.S. or inside the U.S., and we need to lower rates again to cushion against that shock. Well, you have to get rates up there to do that. So I think they want to get the short-term rates up a good bit before they start putting pressure on long-term rates by letting the portfolio run off. So I think it'll be a pretty, if I were, my choice would be to wait 9 months, a year or so after the beginning of the raising of rates before I even let that run off.
Joe, what do you have a difference of view about what they should do than what they're doing?
So there's two elements. One is the portfolio, size of portfolio, and I think they've been pretty clear that they're not going to be selling these bonds at all, certainly for at least 5 or more years. And so they're going to have a very large portfolio for going out probably 10 years.
Does that pose any problem to the economy?
No, I don't think it does. And that's the question is, and I think the interesting thing is, where are they heading eventually when these bonds do run off? They're basically prepaid or they mature. There's a statement where they said they want to get as close as possible, consistent with monetary policy operating effectively or whatever, which is kind of a vague statement, but sounds to me like they want to get close to where they were before, although doesn't say that precisely. It says, so it leaves room for a larger portfolio. I would think, personally, I've argued that they should have a very large portfolio, not this large. This is $4 trillion, but I don't see instead of going back to about $1 trillion, which is where they were before, why $2 trillion wouldn't be a good number. These are safe assets that I think people want to hold. I don't see any reason to make them scarce. I think it's actually a public good the Fed can provide, uniquely can provide. They're helping transactions.
The assets being Fed reserves.
You mean the reserves, not
They,
the other side?
they hold the bonds, and instead they give people short-term liquid assets.
They give the banks reserves at the Fed, which are the ultimate transactions vehicle for our economy. And we used to run the economy on a tiny amount of reserves, which seemed kind of crazy in retrospect to me. And I see no reason why we should make those scarce anymore. I think we can pay interest on them, so they're not so costly to banks to hold, and then banks would hold them and feel comfortable that they have a safe asset and they can make their payment on time and they don't have to scramble to turn these things over really fast every day. I think it just makes a lot more sense to run the economy that way. It's not clear. The Fed is not clear as to how close to the old system they want to go yet. I would say don't go that close.
I think more particularly they've announced that they're going to study long-run operating procedures, decide where they should go, and that will then determine whether they go back to where they were. If they say, no, it was as good as it gets.
I suspect that they don't all agree on where they want to go, which is why they're being very vague.
And they also, that's several years down the road now. You talk about the Fed forecasting, 2 years from now, that's hard. What are things going to be like 6 years from now? That they have time to study that, and they have said they are studying that. I think well in advance of adopting a normalized stance, they'll make clear what that normalized stance is likely to be, and they actually have left it open. They're going to have no more reserves than they need for whatever operating procedure they settle on. That's about nearly a tautology.
So, Julia, does the market care if the Fed has $4 trillion or $2 trillion?
Or $1 trillion.
Or $1 trillion?
I think the market would care if the Fed started selling assets, which they've already taken off the table. I think one of the unknowns is how well they're going to be able to control short-term interest rates, how well they'll be able to hit their target, how big the reverse repo facility will have to be to control short-term interest rates in light of the fact that the balance sheet is so large.
So just to translate, so the way they used to move short-term interest rates is not going to work with a big balance sheet. So they have to adopt some new tools.
Soak up some liquidity.
And they've been playing with those new tools, experimenting.
I think testing is the word that they
testing
use.
new tools, but because it's something they haven't had to do in real life, they don't really know. So that's one question mark.
That's one question mark. The testing has gone well. They think they understand the mechanics. They've got some sense of the dynamics. But we actually have to raise the target rate, see where whether the rate lands in the range that they have set as the target. Again, how big does that facility have to be? How does that affect funding markets? These are sort of the plumbing questions. And the plumbing questions will, I think, have some influence on how they decide to manage longer-term balance sheet policy. If those plumbing issues work well, and there's no political sensitivities to all of these machinations, then they don't necessarily need to make decisions. And as Don said, they can push that down the road, get those short-term rates up to a comfortable level, and make those decisions later. And I think optimally that's where they want to go. But we're going to have to try it out and see. That one, it could be that they don't work as well, and then you actually need to start thinking about reducing your balance sheet and getting liquidity absorbed that way. Or there is, for whatever reason, some political sensitivities to paying this much interest to banks or having this large a reverse repo facility with money market funds. It's hard to predict. But
Okay, so get beyond actually how they managed to get to control interest rates again. I think a lot of people think, well, God, the market must be terrified because the Fed owns so many bonds, or that somehow this allows the federal government to do a lot more deficit spending than it would otherwise. Does the fact that the Fed has such a big portfolio have any implications for the markets that you take seriously?
Not really. I mean, on a day-to-day basis, there are other market structure questions that we're facing. We've seen a lot of increased volatility and different kinds of volatility than we've had in the past. That's sort of an unrelated issue or tangentially related.
That has to do with the new rules on banks.
New rules on banks, new regulations, the high-frequency trading influence. There's all these question marks about new market structures and how they're influencing market liquidity and dynamics. That matters very much. But in general, I don't think the fact that the Fed is holding $4 trillion in assets really affects day-to-day market functioning.
Okay, Don, we've been talking mostly and deliberately about inflation and unemployment and growth, because those are the major responsibilities of the Federal Reserve. But we know that financial stability is also a concern of the government and a concern of the Federal Reserve. And the kind of conventional explanation from Janet Yellen and others is, okay, we're going to use interest rates, maybe a little differently than we did in the past, to steer the economy towards this wonderful place of maximum employment and stable prices. And if we have bubbles or risks about financial stabilities, we're going to use all these other things that we've come to call macroprudential tools, so that those people who think we should raise interest rates to burst a bubble are making a mistake, because we can use these macroprudential tools. So based on what we know now and your experience in the UK, how well equipped is the Fed and the US in general to use these newfangled macroprudential tools to avoid a repeat of the crisis?
Not as well equipped as I think they should be. So I agree with Chair Yellen and many others that have said that raising interest rates ought to be the last line of defense for financial stability, steering away from the inflation target, from the employment target. But it is there, and if the other stuff fails, then you could have a worse situation like the global financial crisis if you don't do something about it. So we have created in Dodd-Frank and in regulation a lot of new tools on financial stability, in particular capital and liquidity for banks and bank holding companies, designating large non-bank institutions systemically important, subjecting them to additional scrutiny and additional regulation. So we've done a lot, but I do worry that we haven't done enough, and in particular I worry about the housing market. So if you think about where financial crises have come and financial cycles have come in the United States and many other places, it's through housing. Think about the 80s, late 80s, early 90s, the S&L crisis. Certainly 2007, 2008 was housing crisis. And we basically don't have tools to directly target the housing market the way many other countries, including the UK, we on the Financial Policy Committee can raise and lower loan-to-value ratios, loan-to-income ratios. If we think there's a bubble developing or a depression or a recession developing, we could lower things to make credit easier to get in the residential housing market. And there's nothing like that in the U.S. So I think where our tools are limited, and the last line of defense is further towards monetary policy than I would like it to be because of that. And I worry about the decision-making also. The Financial Stability Oversight Council has 10 or so agencies on it. It's chaired by the Secretary of the Treasury. I'm not sure this is a good mechanism, governance mechanism for making counter-cyclical financial macroprudential policy. I think the Secretary will be quite conflicted certainly in even-numbered leap years. And it looks like these campaigns begin a year before that. So, and the other agencies don't have the same financial stability focus that the Fed has. So I think there's room for improvement in the way the U.S. handles this.
Does anybody else have views? John?
Can I add one thing that Don talked, there's sort of two things to think about that Don was talking about, and I want to make sure we're clear about the difference. There's general resilience of the financial system, lots of capital, and I think you'd agree that there's been a great deal of progress making everybody on average more robust, more resilient.
At least all the banks and the bank holding companies. Outside of that, a little less clear.
Yeah, I completely agree. Then let's suppose you've made the system more resilient, not as much as you'd like, but you've made it more resilient, but a bubble appears.
Right.
Then what do you do proactively, and that's the sort of counter-cyclical, and that's where the decision-making is dispersed over a wide range of bodies. The tools that wide range of bodies has aren't as good as they should be. And so responding on the fly as something happens is more difficult here than in many countries, and so I strongly agree with Don on both those points.
Just a quick one. It does argue that if that's the case, then we want to be very conservative in our baseline setting of things like mortgage loan-to-value ratios and debt-to-income ratios from the start, presumably. And I don't know if we're really where we should be there.
Yeah, that's a good point.
And I would also like to make the point that even if you did think that monetary policy should be used, remember that the worst part of the housing bubble developed very close to the peak of the interest rate cycle. A lot of the excessive credit layering and derivative developments that prove so problematic for banks happened close to the peak of the interest rate cycle. So it's not necessarily the monetary policy mechanism is effective anyway in controlling bubbles. You really do need something that's far more micro-oriented towards the particular structure or market that you're focused on, and housing is obviously, and the problem with housing is, of course, that it's very politically sensitive. How the UK developed that is impressive.
It's all done.
I'm sure he had a lot.
And how it works the first time, it's a really big problem.
Well, the best thing they did is the first time they did something,
really
they set it high enough so it didn't affect anybody instantly, right?
So what we did was to try and set it high enough so that there wasn't much effect, and it was basically insurance against the deterioration in credit standards as house prices rose relative to incomes and other prices. But I was surprised, actually, pleasantly surprised, at how little pushback there was from the political environment in the UK to this action. I thought we were going to hear more about first-time home buyers and things like that. And I think part of it was set up. So there were a series of speeches by deputy governor and others worried about the house price situation and what was developing outside London. And I think that, and enunciating why it might be a concern. And then I think the action we took was pretty modest relative to that concern and pretty proportional. So it worked out pretty well.
Take questions in just a moment. So let me I want to pick up on one thing that Don said at the beginning and see if you have any thoughts. So you made the point, Don, and John did as well, that productivity growth in this economy has been very disappointing, so that output per hour of work has grown very slowly. That has a lot of long-term implications for living standards and wages. Do any of you think that that's something the Fed can do anything about other than just observe it and talk about it? Or is that the province of somewhere else, the rest of the government? Or
one point that Yellen has made, which is a little bit unorthodox, but I don't disagree with, is to the extent that they can actually really let the recovery develop some strong legs and, really let the economy gain some momentum and strength, you can argue that could lead you to a better place with better productivity. So it really is important, I think, to let that recovery mature and have some momentum, potentially giving you some spillover effects to things like, to the extent that we think that there's a hangover of risk aversion, either for firms or for people making decisions, and you actually let that fade away enough to where they're taking risks with changing jobs more often, or they're taking risks with starting new firms. Allowing the recovery to really gather momentum can lead you to a better place for productivity.
okay, gentleman right here.
Hans-Roger VB. Mr. Wessel politely alluded to the cacophony which arises from the communication on the part of the Fed. And I suppose the question I wish to pose is, how could one be data dependent and looking at the PCE at 1.2 and provide a prescription which calls for normalization? I'm referring to Vice Chair Stan Fischer, and which ties, I suppose, to the question to Mr. Faust, looking at your paper, which you presented at Jackson Hole last week. How do you reconcile the necessity on the part of policymakers to be somewhat, shall we say, humble, but then at the same time in a call for normalization? I mean, which framework are you looking at? And to Mrs. Coronado, how could you explain the reaction function of the Fed if the Fed does not capture development, I'm referring to global development, in the framework, which are not part of the mandate? Which parameter do you look at, and what would be the coefficient you will assign to the reaction function? Thank you.
Okay, John, do you want to take the part that was directed to you?
Sure. There was a lot of discussion at the Jackson Hole Symposium about the relationship between the state of the labor market and when that starts to provide upward pressure on inflation to get inflation back to target. But I think the basic story that the FOMC will have to be grappling with is these issues that we started out with, that Don really kicked off the discussion very nicely with. We need to be looking 1 and 2 years down the road, and do we believe that if the labor market continues to improve at the rate it's steadily improved for several years, that a year or two down the road that the pressure will have emerged? And then when you say, are they going to normalize in September or even begin normalization in September, that's a very different statement than is 50 basis points better than 25? In other words, that's one step from extremely accommodative to somewhat less so. And so, if they do normalize, this is just the framework. I'm not here saying what they should do. It'll be because they believe that the built-in momentum in the labor market, which they're confident it will continue, and they're confident that will over time provide this pressure. Now, when inflation is at 1.2 or inflation is at 2.8, if that's due to oil prices, for example,
1.2 is core.
What's that?
1.2 is core. Core
So even core is affected by the exchange rate, as we talked about in oil. So it's low, but they made a policy of looking through that. Now I'm not. So that doesn't give you the answer. That'll be the reason. That's the framework that would make sense of it.
And Juliet, so I think the question on international was, where does international fit in their reaction function, their domestic mandate?
Right. So first, let me just make one point on the 1.2. This is, to me, where the timing does matter. The optics and the message have to add up. So if you're telling me that we're putting faith in a Phillips curve framework that we have just written about doesn't work, and the data are at the lows and going down, and I'm going to say it anyway, that sends a very hawkish message about your reaction function. You can say gradual all you want. I've just learned that the Fed's version of data dependence is not what I thought. So it does matter that the data are building your case for you, and you deliver the message at the right time. So I think that's where I differ from the more kind of standard academic way of looking at timing doesn't matter, it's all about the path. The timing matters very much to the message and how the market takes it. On the international side, this is a very tricky thing. The Fed has given us the SEP, and this is kind of to your point about transparency and do we have too much and does it give us a headache. They've given us this summary of economic projections that's all very domestic, and they really rely on that to kind of frame their decision. But then there's all this stuff outside the SEP, right? The summary of economic projections is very much a Phillips curve framework. Right? We're going to grow above trend, where unemployment will go through the natural rate, and we're going to have inflation coming back up to target. And as we do so, we're going to gradually normalize rates. It's all a very sensible picture. But then there are all these things outside of it that actually affect, I think your term is disparate.
Confounding dynamics, yes.
Disparate confounding dynamics. The way I describe it is just pragmatic real-world central banking involves taking these factors into account. They've put them in the statement in various ways. They say they're taking into account international developments. I don't know exactly how they're doing that. They don't know exactly how they're doing that. That they have a lot of excellent people on the staff, I think it's safe to say, that provide them judgments about how this is going to feed through into inflation, what are the things we're watching. So we know that they take it into account. And that is why I put very low odds on September, because what central bank would raise rates after a massive, I would say, shock to global financial markets, at least sizable, maybe not massive. The world didn't fall apart, but it's a pretty big shock and a pretty big rumble that you've got to take seriously, and inflation's at the lows. So why would you do it?
Krishna, can you stand up so Mike can find you?
Thank you. So I wanted to weigh in a little on Julia's side of this debate, also someone who's now active in the markets, Krishna Guha, Evercore ISI. It seems to me actually quite dangerous at a moment like this that the committee might look at the markets and sort of say, this is just all noise, it's all volatility, markets do silly stuff. I think we need to take seriously the possibility that there is signal here, that the market is telling you, in particular, the conjuncture of weak break-evens on the one side and the equity sell-off on the other, is telling you that the market perceives not just significant weakness coming out of the EM space, but also heightened risk that if things do get bad enough, the capacity for countercyclical stabilization from the Fed, from others who are at, or at best, even if they've hiked once or twice, will still be very close to the zero bound, is very small. You should expect markets to be extremely sensitive to shock risk at or near the zero bound. And I worry that I haven't seen any evidence yet the committee is taking that thing seriously enough. And in that context, I think it's extremely important that the timing sends a very powerful signal. How attentive are you to those risks? As well as more broadly, how determined are you to get inflation back to target in a timely manner at a moment when the board staff can't even in their base case get it back there within the medium-term forecast horizon. So I wanted to ask Don and John maybe, who've taken the higher probability of September odds side of this debate, whether they agree with the sentiments I've expressed and how you would process this if you were in your old seats as policymakers or advisors to the policymakers.
But I think you've raised a very good point, and one reason to wait is to try and, as somebody, Julie or John or somebody said, Joe, this is about trying to figure out what the markets are saying about the underlying economies and the disinflationary pressures that would feed back on the U.S. So a couple percentage points slowing in China or a decline in the Chinese stock market per se would have very little effect on the U.S. But you do see broader disinflationary forces at work. And I guess one would hope that by waiting a little while, you could process better how strong they were and how they would feed back onto the U.S. So that would be a reason to wait at least a little bit. I agree, but it's not about the market movements per se. It's about what they're saying about what's going on underneath.
Let me add just a couple of small wrinkles to that. I think that the case you laid out, that's what we've been talking about. That's the one they'll be discussing. And as Don said, it's the underlying what it says about the underlying economy. I just want to add two little bits. When you think about the market volatility, I don't think you want an FOMC that says there has to have been at least 3 months of quiescent markets before we'll do anything. And as it turns out, we never get 3 months of quiescent markets. So when the Fed does lift off, whenever that happens, there will be some market turbulence fairly close in the rearview mirror, because there is all the time. So that can't be the driver of policy. So then the question is, you're always deciding what is the financial market volatility telling you about how the economy is performing. And I just want to reemphasize, how much will we learn about whether this weakness, how it's going to feed into the U.S.? Well, we'll learn very little about that over the next few months. That's a thing that will play out over a year. That's what makes that's inevitable, and that's what makes the decision a difficult one. And that they'll. That's why even if Don and I are a little higher than 20%, why it's a difficult decision. Why they'll have I'm sure, a vigorous discussion.
I think one more thing that hasn't been discussed yet is the other side of the weakness that might be coming from internationally is strength within the U.S. So if you thought the U.S. economy and the private domestic demand in the U.S. was strong enough to withstand some of this weakness and still continue to make progress on labor markets, it would still be pretty good. We've had some good news on that over the last, so someone said, what do we know since June or July? Well, we've had a further pickup in the housing market. We've had a bit of a recovery in spending on capital equipment. We've had very substantial auto sales. So I think private demand in the U.S. probably is a bit stronger than they thought it was going to be certainly when they made their last forecast.
In other words, you can imagine a set of circumstances where the U.S. economy is growing fast enough to justify a rate increase, even if they're having troubles in China and Brazil.
Right, because that might take a couple tenths of a percentage point off of growth, but the other stuff is adding, and we are getting close to running out of slack. No one knows how much or where, but it's pretty low unemployment rate.
Okay. Ma'am, here.
Hi, I'm Emily Leiner, Third Way. I have a question for Mr. Kohn. The conventional wisdom says that a rate increase, if it happens this year, would be at the September or December meetings. And everyone seems to believe that October isn't a possibility because of this relatively new tradition of the quarterly press conference. Do you think if the indicators line up by October that the Fed wouldn't move for that reason?
I think they'd be a little more reluctant to move. That isn't to say, because it'd be much better to send the chair out there to explain the context in a predetermined way. So I think you could get a set of indicators between the September and October meetings that were so strong, or prices and wages that could move them. But I think they're much more likely to move in September or December without ruling out October under certain special circumstances.
Okay.
Craig Torres from Bloomberg News. I would like to ask the panel, what about the risks of not moving? Okay, so you don't move. Financial markets say, oh, look how sensitive they are to volatility. We're going into budget debates, and as John said, gosh knows what. So pretty soon, the forward curve flattens out. 2-year notes at 0.7 today, dropped to 50 basis points. household debt starts to rise, home prices in several markets are already rising faster than income. And last but not least, the non-bank lending sector says, oh boy, look at this zero-rate financing, and really starts to reach for high-yield borrowers. So that seems to have not really been addressed by the panel. I'd like to know how risky.
The risk of not moving.
I think they would feel that this would be something that if they dealt with it in December or even October, if it was that strong, things wouldn't have that much time to get carried away. So I don't think they think that.
But how big a risk is that the Fed waits and you get all the bad stuff that
do you mean like
frothy?
The signal that's sent by delaying in September, even if they do tighten in December, it would still have sent a bad signal that would change the market dynamics going forward? I don't think so. I mean, I think, and this is, I think, very important, and I'd like to know what my colleagues think here, but I make a strong distinction between market volatility and market levels. And I was very clear that I think that the levels that I would think about and I think that they think about, and not the volatility. So, when stock markets are down 10% relative to where they were a couple months ago, that is a bad signal for the future of the world economy. But if they bounced down and came back, and they're not down at all, but there was just a lot of volatility, I don't think that will stop them from raising rates.
The risks not going, there's a few that they talk about. One is that, well, if we delay and things get really frothy, we might have to go really fast. I don't think if you delay on September, because you don't need to pin it on market volatility. You can pin it on our own domestic inflation indicators aren't moving in the direction we thought. We don't have reasonable confidence yet. And actually, in their own statement, we've had a downside risk to inflation through the closely monitoring language that they have with regard to inflation. That's a downside bias to inflation risks. You've got to remove that before you have to flag reasonable confidence before you go. So one, I don't think that they've set us up for September and pushing back is some kind of signal that we're scared about markets. And I don't think that's what Janet will say in her press conference if she announces that they don't go. She's not going to say, well, the reason we didn't go was because of market volatility. And so go ahead and scare us every time and we'll just back away. She's going to be couching it within the outlook so it's not going to be we're never going to raise rates message. It's going to be, progress on our mandates isn't quite what we expected, and we've got some risks that are not market volatility, but from the global economy. We'd like to gather a little more information. We still think we're on track. It's not going to be never. So I don't think it would be like opening the spigots to
Can I add just one thing that I think that was implicit in what everybody said, but that's worth mentioning? I think most everybody agrees that you can think about the risks of things going too fast, too much inflation, or going the other way. And the risks going down are more concerning because the Fed has less tested and less available tools to help deal with that. Whereas inflation is something that central banks have many times let get higher than they like, and they know how around the world, and they know how to bring it down. They know how those tools work. So it's somewhat less concerning. That's one point.
In other words, you're going to make a mistake.
Asymmetrical.
Yeah, there's an asymmetric. And the other point is just, I think sometimes market people would take a sign like not going in September as they're never going to move. I'm pretty sure that you won't hear Janet say the market scared us, so we didn't move. Right. I don't think the chair will say that. On the other hand, I think it's likely it will be. We're unsure what all these changes in the data and what the financial markets may be telling us about the real side of the economy, and we would like a little resolution on that. And that's a much different position. And over a couple of months, you see a few numbers that say we didn't fall off the table, and you move.
Well, the woman holding the piece of paper, if you stand up so the mic can find you.
Thank you. I'll take just a second. And the Main Street. This is Cindy Walsh, and I'm an academic on public policy, including economics. Main Street really does kind of understand what's going on, so I'm going to just give a Main Street perspective very quickly. The numbers show that participation in the workforce is now at 61%, lower than in the 1960s. So unemployment is actually probably closer to 20%. Inflation seems so low because so much of it is placed on fuel, and fuel is low because of the competition between natural gas and oil. That's temporary. Main Street, of course, is dealing with health and food issues that are spiraling to almost 200%. The interest rate, we're concerned about the fact that the level of debt that's being taken on specifically through U.S. Treasury bonds at the federal, state, and local levels is so great and has been leveraged to such a height that we are almost sure that there's going to be a bond market collapse because there's going to be a exiting of people from these bond investments. This is going to cause a crash. And so the general consensus is that inflation is actually probably now at about 4 or 5%. A bond market crash would bring that rate up to possibly 7 to 9 or 10%, and the interest rates would be forced up.
Okay, so can you, I hear your...
So my question is, we would like to hear you address it from those perspectives, because that is the perspective that Main Street sees. And I think that you're dealing with more of what the effects of Wall Street will be.
Let me take a cut at that, if anybody else. So first of all, I think we probably would disagree with the numbers you use, though I am certain that many people think inflation is higher than the Bureau of Labor Statistics says. I take that. I think that I'd like the panel to take one point that you made. So whether Main Street is concerned about bond market funds, I'm not convinced, but a lot of people in financial regulatory circles are. And so one concern is, after all this time of all this energy of central banks all around the world holding down interest rates and making bond funds, people reaching for yield and all that, is there a risk somehow that once the Fed makes a small step towards normalization, there's some kind of really big problem? Is that something worth worrying about?
So you couldn't say the risk was zero of that. And I do think bond markets will, but I don't think it's huge. That is such a big reaction that it threatens the financial stability of the United States or the global economy. I think bond markets are likely to react, in part because there are a group of people out there who say they'll never raise rates. The inflation's too low. They were scared by the summer of 2013 in terms of the taper tantrum. They'll never even talk about it, and they'll never raise rates. They'll always find an excuse not to raise rates. And once they raise, of course, those people get flushed out of the market. So I'd be surprised if bond markets didn't rise, and markets aren't as liquid as they used to be. But bond prices didn't fall and rates didn't rise. But I think the Fed can't let itself be frozen in those headlights. That's got to do the best it can to talk about gradual thereafter to damp down the bond market reaction, if that's its true view of what it's going to do, and then take the steps it needs to take and work on the bond market volatility and whatnot through other means.
Ma'am, here in the front, and then there's a guy, Rich. No, come down here. Just is there another mic? Rich, can you stand up so that she can see you? You can go next, please.
Thank you. I'm Jennifer Lee with Hong Kong Phoenix TV. A question about China's role in this global volatility, and a question for Mr. Kohn, if I may, because you just went to China. You've talked about a couple of reasons, including macro issues or the U.S. economy or other reasons, but I think the most popular explanation was people were worrying about China economy's slowdown. But it looks like everything start this time was because they adjust the midpoint mechanism and devalue the renminbi. So do you think what China play, the role China play this time in this global sell-off is just purely economy problem, or it is related to their policy transparency that caused the uncertainty? And if China government really play a key role here, what should they do next time to avoid uncertainty?
I think both of the above. So I think people were concerned that the Chinese economy was slowing and they weren't sure by how much. And Julia cited a bunch of data that suggested it might be really weak. Now, the data that suggested really weak is all from manufacturing, sort of old economy stuff. And we know China is shifting to services, and we don't have very good data. And my impression in Beijing was the government didn't have very good data either on what's really happening in the economy. So that was this uncertainty, and the fact that the government was acting and then they built in the 2% devaluation suggested they might be more worried than people thought before. And that brings me to the second point, which is communication by the Chinese government, by the People's Bank. They did this on a Monday or Tuesday. They didn't have a press conference until Friday. So if you're going to change your exchange rate regime, I think you need to have a very clear story about what you're doing and why you're doing it, and then explain it simultaneously with you're doing it. Now, I know the Chinese don't have a lot of experience doing this because they don't have a domestic press the way the US and Europe have a domestic press pushing them all the time on what they're doing and why. But they're playing in a global economy now, obviously. And I do think improvement in communication, clarification of framework, and more immediacy to the communication is absolutely essential.
Can I add to that? I think that's an incredibly excellent question. You've put your finger on, I think, what one of the biggest changes over the last 2 months has been is the perception of the Chinese policymakers. So we have lots of data out of China on things like the credit situation that's been developing. There's been a lot of concerns for the last couple of years about how much credit growth there has been, the shadow banking system, ever more credit growth, ever less GDP. And we have always worried about China as a risk. And the pushback has always been, whether it's from investors or policymakers, has been, oh, but it's China. They have a plan. It's a centrally planned, it's a new strong regime, centrally planned government. They'll be able to manage it. And what the news has been is that actually they don't have a plan. And the plan changes from week to week, and it doesn't work like they thought. We hear more disparate voices out of the policymakers. This is a very big change in perception. And so I think for me, a lot of the volatility and the level change has been, this is a bigger risk than we realized. And so it's taking that into, and now it's difficult because when you're in a credit crunch, you have to kind of throw different things out there and see what works. It's not clear cut. There's not a clear cut playbook, especially out of China. So by its nature, you're going to look a little bit lost at times. The US did, Europe did. And so we're going to be in this process, I think, for a while as they figure out what the plan is and what is effective.
Rich?
Rich Miller at Bloomberg, thank you. I was wondering about December, the lack of liquidity in the markets, will that affect the decision? And two, I want to pick up on something Julia Coronado said about the communication process going forward. And I would be interested in hearing what other people have to say about how they sort of don't get so deterministic as they were the last time, but don't get the sort of market carnage in Orange County, Mexico, as David alluded to 94, 95. As Julia said, it seems difficult. Every meeting is live, so are they going to react to the latest employment? How are they going to communicate?
Okay, so the first question is December. Traditionally, people think there are fewer people in the markets in December, so you get overreaction.
I know. I'd be surprised if that held them back.
Right.
So especially if they in their October statement, for example, gave a pretty big clue that it was coming in December. The markets would already build it in. And if they really think they need to move, I would hope that, and I'll bet all these people will be at their desks
Oh, they'll be
during the press
be at their desks on
conference.
FOMC.
Still like a week
Yeah,
before
for
Christmas,
sure.
2 or 3 weeks before Christmas. You can
Yeah,
still go to the islands for Christmas.
Yeah, it's not the typical December. This is a special December if we're at that moment. And they'll come to work.
So it's going to be a great time to get the hotels where the hedge fund guys stay in Bahamas, that right around the FOMC meeting, they'll have no business. and Rich's other question about how do you manage, John, how do you manage this tricky thing of we don't want an overreaction, but we don't want people to think we're mechanistic?
I think that's very difficult, and that's the sweet spot that the Fed's been attempting to hit, and it's difficult. I think on this data dependence, I think sometimes that makes it seem as if the FOMC is saying we're on the edge of our seat all the time, about ready to tip one way or another. But that's not really the case. I think they need to communicate more effectively, as Don said earlier, that it's outlook dependent, and the outlook changes. The outlook for a year to 3 in the future changes rather gradually. And so it's affected by Friday's employment report, but not by much. And that's really, I think, where there's been some, in being earnest in saying, look, nothing is chiseled in stone, they've almost made it seem like sometimes the message should come across as if they're skittish or something, and really it's outlook dependent. The outlook changes very gradually, as most of the time. In good times, it changes, a little bit of information comes in, you marginally change the outlook. That marginally changes what policy may be. And I'd like to see the communication move more in that direction, because it conveys, Julia said earlier, the market has an impression they behave one way. I don't think they behave that way, Julia said, and that's what we're talking about, convey more this outlook dependence.
There's one gentleman against the wall.
Thank you. I'm Nick Farmer. Can you speak to some of the macroeconomic issues, things like changing demographics, aging the population, changing the fact that U.S. corporations sell more and more of their product overseas, automation, robotics, artificial intelligence? Are these things impacting the interest rate, productivity, labor issues in a way that's dramatically different than it has been in the past 50 years? Does the Fed take this adequately into account? What are they doing about these issues?
So,
Big question.
yeah, it's a big question. I can only answer pieces of it, but I can also throw one more piece in, which is, so some people have been arguing that a number of things which you cited, demographics, slower changes in productivity, are causing the interest rate that the economy needs in equilibrium to go down, to have gone down. And I think we've seen that. And I think the FOMC itself has seen that, because when you look at their long-run projection of where their policy rate will be, it's come down from about 4.25 to about 3.5. And as I said earlier, I think it may have a bit further to go. But that's more of a long-term thing. These aren't things that happen and change day to day or month to month. This is more of a trend. But you said over 50 years, so I think it's a trend. Let me add one big thing that you didn't mention, which I do a lot of work on, and that is the behavior of foreign countries, and particularly foreign governments, in terms of saving and investment. It used to be that developing countries would borrow for development, and then they would borrow from us, and they would invest at home, and we would export to them, and they would grow. And then there were a lot of problems with that strategy, and sometimes the investments didn't pay off, and there were debt crises and stuff. And about 10 years ago, after the Asian financial crisis, countries really made a dramatic change in that strategy. And what you see now is countries don't borrow for development on the scale they did before, and in fact, on average, emerging markets are vast net lenders to the U.S. and Europe, but especially to the U.S. And so we have a massive wall of money coming in instead of going out that we never had before. And that, I think, has hugely contributed to low interest rates in the U.S. And it's also holding the recovery back to some extent, because normally in a recession, when we have a trade deficit going into the recession, it goes away during the recession, then maybe it comes back gradually later. Well, we only lost half of our trade deficit in this recession despite the depth of it, and it's starting to come back already quite a bit. So I think this is a change in the dynamics of the world economy that keep interest rates down in the U.S.
This was Bernanke's global savings glut.
Which could be changing.
Which
I mean,
could
that's
be.
actually one of the changes we've seen out of China is that they are now running down their FX reserves for the first time in 25 years. That could cause a change in interest rate dynamics that we don't know yet.
Well, the key thing is that I see for this year, absolutely, but that strikes me as market volatility that's probably not going to persist. But we'll
Or
see.
a change in exchange rate regime.
Hasn't changed it. Not really.
So,
the
I
question
want to
is
make one near-term point on the demographics. One near-term implication for policy that we might even see in September is there's a debate and a discussion about whether that aging population has led to a lower natural rate of unemployment. And you might get that because there's less turnover, people are in their jobs longer, and so we think of the natural rate as that sort of level of churn in the labor market. It might be a lot lower because of demographics in part, and therefore you might have more slack than you thought, and we might see that in the summary of economic projections in September, that you have a lower natural rate because of, in part, demographic issues.
And just to, demographic issues may imply that the unemployment rate isn't as good a single summary statistic as it used to be, that we have to think more about labor force participation, especially as it interacts with the deep recession we've had. Are some of the folks that left the labor market perhaps retiring early because they lost their job and didn't see prospects? If the economy's more healthy, do they come back and work for a while? Those are important questions. You ask, does the Fed think about these and deal with them adequately? They're very complicated topics. They're definitely all being discussed. You can see it even in the minutes and the speeches of the FOMC members, in the working papers put out by the Fed. Does anybody have a great handle on those? That we have yet to see. They're difficult issues about interactions between long-term changes in our economy and ones that may be precipitated by the financial crisis but will go away.
Want to add anything, Don?
No. I think
Okay. Well, please join me in thanking our panel.